Trading in the Zone. What can we learn? Trading in the Zone by Mark Douglas offers a unique understanding of connections between the human psyche and financial markets. In this blog post, we dive into the depths of this masterpiece. Ever since the advent of stock markets, traders have scoured the globe for strategies to beat the system, inching their way towards a higher return on investment. Among the plethora of financial books, very few delve into the intricate connections between the human psyche and financial markets. Mark Douglas's Trading in the Zone offers this very perspective, illuminating the profound influence psychology holds over trading outcomes. Douglas breaks down the tenets of trading psychology, emphasizing the importance of mental state and belief systems in the volatile environment of trading. He doesn't promise foolproof strategies or secret formulas to skyrocket profits, but instead offers an invaluable toolkit to master the emotional whirlwind associated with the markets, setting a robust foundation for informed decision-making. One might wonder, why the focus on psychology? After all, aren't the financial markets driven by hard data and factual information? Yes and no. While the financial markets function on the basis of tangible data, human interpretation of this data, imbued with personal bias and emotion, plays a significant role in market movements. An understanding of this dynamic empowers traders to better navigate the trading environment, thereby improving overall performance. Trading in the Zone is not just for those directly involved in trading, but also holds valuable insights for anyone seeking to understand the mechanics of decision-making in uncertain situations. As we delve into the key ideas presented in this seminal work, it's important to understand that the principles go beyond the stock market, applying to broader life contexts as well. As we unfold the wisdom in Douglas's masterpiece, we will explore 18 key ideas with in-depth analysis and practical examples, helping you to understand how this knowledge can be applied to improve your performance in financial markets and beyond. So, fasten your seatbelts and get ready for an enlightening journey into the zone. Key ideas from Trading in the Zone. 1. Embrace uncertainty. Uncertainty is a constant in financial markets. Traders often struggle with the unpredictable nature of the markets, which can lead to anxiety and hasty decisions. Douglas encourages embracing uncertainty as a natural part of trading, which can lead to improved decision-making. For instance, a trader who acknowledges uncertainty would be more likely to develop risk management strategies, such as stop losses, to mitigate potential losses. 2. Cultivate a winning attitude. A winning attitude isn't about being right all the time. Rather, it involves maintaining confidence and composure, especially in the face of loss. Consider the best traders on Wall Street. They've all had losing trades, but their positive attitude keeps them in the game. 3. Mental state matters. Traders often overlook the importance of their mental state on their trading performance. However, stress, fatigue, and anxiety can drastically affect trading decisions. It's essential to manage one's mental state, just as one would manage their portfolio. The application? Be disciplined about taking breaks and maintaining a healthy lifestyle outside trading hours. 4. Accept responsibility. Only when traders accept complete responsibility for their actions can they gain true control over their trading. This involves acknowledging that the market isn't against you, it's simply reacting to a multitude of factors. For instance, if a trader bought shares that subsequently plummeted, blaming the market or bad luck is unproductive. Accepting responsibility allows the trader to learn from the experience. 5. Understand probability. Understanding the probabilistic nature of financial markets helps traders manage expectations. Each trade represents a single event in a series of outcomes, much like a coin toss. Understanding this can help a trader avoid the trap of overconfidence after a series of successful trades. 6. Limit beliefs and emotional interference. Every trader carries a set of personal beliefs into trading, which can sometimes cloud judgment and lead to emotional decisions. Strive to separate personal biases from trading decisions. For example, a trader with a strong belief in a particular company might ignore signs of financial trouble and hold on to stocks longer than advisable. 7. Discipline and consistency. Applying trading strategies consistently and maintaining discipline even in volatile markets can significantly improve trading outcomes. This could mean sticking to your planned entry and exit points, even when the market tempts you to stray. 8. Understanding risk. Douglas emphasizes the significance of understanding and accepting the risk associated with each trade. This acceptance alleviates fear and allows for clear-headed decisions. For example, never risk more than you are willing to lose and always have a clear understanding of your potential downside. 9. Objectivity. To trade successfully, one must learn to observe the market objectively, free from the distortions of fear and hope. A trader should, for instance, refrain from projecting their hopes on an uptick in a falling market without substantial supporting evidence. 10. Building a belief system. Traders must create a robust belief system based on market understanding and personal experience. This belief system forms the basis for trading decisions and helps maintain consistency. For instance, a trader might believe in investing only in companies with strong environmental, social, and governance (ESG) practices. 11. Edge definition. Every trader needs an edge, a method that gives them a higher probability of winning over losing. The edge could be a unique analytical tool, like Central Pivot Range, CPR, or a specific understanding of market trends. It's essential to define, trust, and consistently apply this edge in trading. 12. Perception of information. Perception of market information is subjective, and recognizing this subjectivity is crucial for trading. Two traders might interpret the same piece of news differently based on their biases and belief systems, leading to different trading decisions. 13. Overcoming fear. Fear is a dominant emotion in trading that can lead to irrational decisions. Douglas emphasizes the need to overcome this fear by accepting the risks involved in trading and trusting one's system. For example, a trader might fear entering a trade after a series of losses, but overcoming this fear and trusting the process is key to long-term success. 14. 5 Fundamental Truths. Douglas introduces 5 fundamental truths to assist traders in accepting the inherent uncertainties of the market. Anything can happen. You don't need to know what will happen next to make money. There is a random distribution between wins and losses. An edge is nothing more than an indication of a higher probability of one thing happening over another. Every moment in the market is unique. 15. For primary trading fears, Douglas defines the 4 primary trading fears: fear of being wrong, fear of losing money, fear of missing out, and fear of leaving money on the table. Recognizing and addressing these fears can greatly improve trading psychology. 16. Creating a mental framework. Traders must build a mental framework to interpret market information. This involves constructing a coherent belief system that aligns with their individual risk tolerance, goals, and trading style. 17. Developing self-trust. Building self-trust is crucial in trading. It involves trusting one's ability to execute trades based on their system, regardless of market fluctuations. For instance, a trader must trust their decision to sell a particular stock when their system indicates, even if the market seems bullish. 18. Continuous learning. Trading is a continuous learning process. Market conditions change, new tools emerge, and personal circumstances evolve. Staying open to learning and adapting one's system accordingly is essential for consistent success in trading. Mark Douglas's Trading in the Zone is an extraordinary guide that takes you beyond traditional trading strategies into the realm of psychological resilience and mental mastery. It provides a fresh perspective on trading, emphasizing the importance of individual belief systems, discipline, and emotional control in decision-making. The financial markets are indeed a battlefield of numbers, but Douglas illustrates that the most intense battles often occur within the trader's mind. Douglas's teachings go beyond the confines of the stock market. They apply to all areas of life involving risk and uncertainty. By acknowledging the role of personal psychology in decision-making, we not only become better traders but also gain insight into managing risk and uncertainty in various life situations. As we conclude this exploration of trading in the zone, remember that the path to becoming a successful trader is not a straight line but a continuous journey of self-improvement and learning. Trading, at its core, is a journey within. It's about knowing oneself, accepting the unknown, trusting the process, and most importantly, consistently applying your own unique edge in the markets. The zone, as Douglas puts it, is not a place, but a state of mind. So, equip yourself with these powerful insights and make your way into the zone, in trading and beyond. Trading in the zone summary notes. Have confidence in trades. Focus on opportunities. Fundamental analysis is the study of finding supply and demand of an investment based off fundamental information. Technical analysis is based off patterns in an investment's historical data. Technical analysis is more in the moment than fundamental analysis. You react in the moment to changes in prices. Good traders have rules for entry and exits. Accept risk before putting on a position and never assume you are correct. Be quick to admit you're wrong. Accept the possibility that you will lose money so that you can objectively manage a position. Good traders aren't afraid because they have effective management strategies to enter and exit trades. The 4 primary trading fears are: 1. Being wrong. 2. Losing money. 3. Missing out. 4. Leaving money on the table. We blame the market for our losing money. How you view the market affects the consistency of your results. You can never know the myriad of ways the market can make you lose money. Accept that the outcome of a trade is unknown, and that one trade is not a reflection on you as a trader. Failure to accept this leads to costly decisions. Doing more market analysis will not make you a better trader. Acceptance of what the market is will. Accept the risk you take on with every trade, and you will no longer be afraid. Trade without fear, and have rules to prevent reckless behavior. The market presents you with unlimited possibilities, and this can challenge those not equipped to deal with this fact. Desires are generated internally, but must be fulfilled externally. Once we identify a desire, we are drawn to fill that desire externally. Denial of this opportunity to fulfill a desire leads to pain. Accept that trades are a probabilistic outcome, and define how much risk you are willing to take on this probability. Prices always move. Your entries and exits last as long as you want. The market will not make you exit a trade. You must do that. Don't be a passive loser. Actively lose by defining your risk. Trading gives you ultimate freedom. This can be a curse because you have no structure to follow. Most of those who get into trading initially struggle to create a set of rules to follow. That which draws us to trading is the same thing that makes us resist creating trading rules. Your impulses hinder your ability to trade well for psychological reasons. You must keep yourself responsible for the way you take profits and take losses. If you play probabilistic edges, you must be consistent in how you trade them and not get thrown off by a few losing trades. Don't get hung up on any single trade. Adapt to your environment and create rules so that you can adapt appropriately. Winning early as a trader can hurt your long-term performance. Trying to understand why the markets do something can hurt you in the long run. Your mental attitude will produce better results than analysis alone. Trading can be a simple pursuit in which you don't need a ton of skills, but rather a winning attitude. Operate from the belief that trading losses are a natural part of trading and should be considered as your business expenses. We feel pain when reality fails to meet our expectations, especially when they are unrealistic. Losing traders blame markets for their losses. You blame markets for your results if you don't accept the randomness of markets, have rules to protect you against this randomness, and take responsibility of your results. Your goal is to extract money from the market, and the market's goal is to extract money from you. Markets owe you nothing. Don't blame them for your losses. Take complete responsibility of your trading. Otherwise you will view the market as your adversary, and you believe that your problems can be fixed by better analysis. Every entry and exit on a trade is an opportunity for you to act in your own best interest. You are never fighting the market, because it owes you nothing. Learning about markets isn't bad, but it can give you a false confidence that you know what will happen next and ignore the randomness inherent to markets. Learning more about markets isn't going to eliminate losing trades. Don't take losing trades personally. Accept your losses and you will no longer view market information as painful. You will view it as it is, information. Our bias to avoid pain makes us ignore or alter information that the market provide us. In sports there is a more discernible connection between one's focus and results. It's harder to see this connection in trading. Leaving money on the table can be more painful than taking a loss because you know you missed out on a large profit. Make winning and consistency are states of mind. Make yourself available to what the market is offering you. Our biases make us interpret information that is favorable to our own egos, even though it can hurt more in the long run. Fear causes 95% of the errors you are likely to make. Think about trading in a way that keeps fear at bay so that you can continue to focus on opportunities. Let the market unfold and make yourself available to opportunities with a clear mind. Accept risk and you won't have anything to fear. You see what you've learned to see, and miss that which you haven't learned to see. Every trade is an edge with a probable outcome. Know this to define your risk and eliminate your fears. Perceive the market objectively. Don't project your own feelings on the market. Your emotional mind links your current state to your most recent trading experiences, which can be painful and create a fearful state of mind. The secret to trading well is 4 items. 1. Trade without fear or overconfidence. 2. Perceive what the market is offering clearly. 3. Stay focused on the now moment opportunity flow. 4. Enter the zone and believe in an uncertain outcome with an edge in your favor. Great traders don't let emotions of recent trades influence their process. To be a consistently successful trader, one must learn adapt. It can take years for most traders to figure out that consistency trumps picking the occasional winner. The best traders cut their losses without hesitation if the market tells them it's not working. The 3 most costly trading errors you can make. 1. Not predefining your risk. 2. Not cutting your losses. 3. Not systematically taking profits. Thinking that you know what will happen next is the cause of most trading errors you will make. The most effective trading belief you can acquire is anything can happen. Every trader acts on their own belief about what is high and what is low, and collective behavior pattern is displayed in the price at that moment. Every trade you make is unique from every other trade you've made. Train your mind to think in probabilities, and have actions that you take to deal with these unknown outcomes. Don't ever convince yourself you're right when you enter into a trade. Instead, define the risk. When you think you know what will happen, you are effectively thinking you know the future actions of every single individual and how they will move prices. Markets are unique, anything is possible. To ignore this fact is foolish. Your beliefs are shaped by your expectations. These beliefs cause you perceive market information that confirms your bias, and ignore market information that conflicts with your bias. Market information that goes against our position is ignored when we find it too painful to acknowledge. We focus on information that helps minimize our pain, which is destructive to our trading. We lose out on opportunities when we choose to ignore what the market is telling us. Our pain avoidance mechanism shields us from seeing information that is not aligned with our beliefs. Traders must learn to be rigid in our rules and flexible in our expectations. There are 5 fundamental truths you must accept to think probabilistically. 1. Anything can happen. 2. You don't need to know what will happen next to make money. 3. Wins and losses are randomly distributed for any given edge. 4. An edge is an indication of higher probability of one thing over another. 5. Every moment in the market is unique. When you put on a trade, your only expectation is that something will happen. That's it. Define a stop loss for every trade. This should be some point where the odds of success are greatly diminished in relation to the potential profit. Losses are the cost of doing business in the course of finding winning trades. Each moment in the market is an opportunity to do something on your behalf. You always have an opportunity to 1. Scratch a trade. 2. Trade profits. 3. Cut losses. 4. Add or detract from a position. Expectations are beliefs projected into some future moment. We can't know what to expect from the market because other traders are always there to enter and exit trades based off their own beliefs about the future. The only thing you should know in trading is what an edge looks like, how much you need to risk, and a plan for taking profits or losses on a trade. You can never know if any one trade will work out. Don't have an agenda when you trade. Make yourself available to the opportunities the market makes available to you with a clear mind. Emotional pain is a response we have when the world expresses itself in a manner opposite of our beliefs. Don't expect the market to make you right or wrong. Don't expect the market to go in your favor forever. Establish rules for taking profits. Gathering more information to predict if a coin will flip heads or tails is silly. Why would you expect it to work in the markets? Remember that every trade is probabilistic. Every moment is unique, and therefore you will never know what will happen next. Don't try to change your beliefs. Remove the energy behind that belief, and channel it towards better beliefs. It's hard to make new discoveries when your internal beliefs conflict with those discoveries. The underlying cause of fear in trading is interpreting market information as threatening. You must believe that every edge has a unique outcome in order to trade without fear. You must believe you don't know what is going to happen next. Train your mind to expect a unique outcome in order to see market information objectively. Believe that each moment is unique in order to achieve mental freedom while trading. Trading is a pattern recognition numbers game. Identify patterns for some edge, define your risk, and take profits consistently. Some trades work and some don't. Don't take it personally. Trading is one of the hardest things to do because the more you think you know, the less successful you'll be. Manage your expectations as a trader and align your mental environment with the 5 fundamental truths. 1. Trust yourself to operate in an unlimited environment. 2. Focus on flawlessly executing a trading system. 3. Think in probabilities, the 5 fundamental truths. 4. Create a strong belief in your consistency as a trader. Your primary objective as a trade should be to produce consistent results. The way you do that is by following your trading rules with unshakable confidence. Consistency should be your primary reason for trading. Making mistakes will happen until your beliefs are in harmony with your desires and your beliefs are consistent with what works from an environment's perspective. Don't think less of yourself when you make mistakes. Mistakes should not hold negatively charged energy for you. Beliefs must be in alignment with goals and desires to eliminate any conflicting energy. You must create the belief that you are a consistently successful trader. Don't make it a goal to guess correctly. Make it a goal to be consistent with your techniques. Tell yourself, I am a consistent winner because 1. I objectively identify my edges. 2. I predefine the risk of every trade. 3. I accept risk and am willing to let go of trades. 4. I act on my edge without hesitation. 5. I pay myself as the markets make profits available to me. 6. I monitor myself for my susceptibility to make errors. 7. I never violate these principles above. To be an objective observer, think from the market's perspective. There are always unknown forces waiting to act on price movement so that every moment is truly unique. The typical trading errors are 1. Hesitating. 2. Jumping the gun. 3. Not predefining risk. 4. Defining risk but not taking a loss. 5. Exiting a winning trade too soon. 6. Not taking profits on a winning trade. 7. Letting a winning trade turn into a loser. 8. Moving stop too close to your entry point. 9. Trading too large a position in relation to your equity. You can change your identity by changing your desires. Losses call for larger percent returns in order to be profitable. A 50% loss requires a 100% return to become profitable again. Divide your position into thirds or quarters, and scale out of the position when taking profits. Take off a portion of a winning position whenever the market presents you with the opportunity to do so. In a 3-contract trade, establish a stop loss, and take profits by scaling out of the position 1 contract at a time. Scale out of positions to create risk-free opportunities. These are positions where you have taken profits to the extent of max loss allowable on the remainder of the position, therefore guaranteeing a break-even trade at a minimum. Try to achieve a risk-to-reward ratio of 3 to 1, which means you risk $1 for every $3 of profit potential. Success or failure of a strategy should be based off a sample size of 20 trades or more. An edge is merely a snapshot which captures a limited portion of all probabilities. Be willing to make 20 trades on a strategy before making a judgment of its effectiveness. Follow your trading rules and focus on the 5 fundamental truths in trading. If you can go through 20 trades without allowing your emotions to influence your adherence to rules and probabilities, then you discover that thinking in probabilities is a functioning part of your identity.